Open. Blackstone is filing to take a data center REIT public at a $1.74 billion raise, with deal activity concentrated in the D.C. metro, specifically Northern Virginia, which already accounts for roughly 35% of global hyperscale capacity. Most of the conversation I'm seeing in the market treats this as a green light. Institutional validation. The AI infrastructure thesis confirmed by the biggest real asset manager on earth. That REIT is not wrong, it's just late. When Blackstone is pricing a REIT for public markets, the spread compression has already happened at the top. What this IPO actually tells you is that the private-to-public arbitrage window in primary markets is functionally closed, and the clock is running faster than most mid-market operators have adjusted for. The more important question sitting underneath this filing is structural. Where does the mispricing still exist for capital that can't warehouse $500 million in a single deal? I'll walk through the data, the mechanism, the specific subsegment where I think the spread is still real, and what I'm actually doing about it right now. The data layer. Let's start with transaction comps, because the numbers tell the story clearly. Northern Virginia, Loudoun County, Prince William County, the core of Data Center Alley, has been trading at cap rates between 4.5% and 5.5% on stabilized, fully leased colocation and hyperscale assets over the last 24 months. That's based on deal flow tracked by Real Capital Analytics and corroborated by Green Street's data center coverage. For context, well-located industrial in the same geography is trading at similar or wider caps, with significantly less operational complexity and without the power procurement dependency. The premium for data center is embedded in lease structure, 10 to 15-year triple net equivalents with CPI escalators and renewal options, and in the scarcity of licensed critical power at scale, QTs, which Blackstone took private in 2021 for $10 billion, roughly 27 times EBITDA at the time, has been the benchmark acquisition in this cycle. That take private was done when the REIT was generating approximately $368 million in annualized adjusted EBITDA. The per megawatt pricing embedded in that transaction, depending on how you allocate across their portfolio, ran approximately $8 to $12 million per MW for stabilized, powered, carrier-dense facilities. That number has since moved. CBRE's 2024 North American Data Center Trends Report noted that demand for data center space hit a record 2,600 MW of net absorption in 2023, while new supply delivered only 1,200 MW against that demand. That imbalance drove powered land and shell pricing materially higher in the primary markets. Now, Blackstone's REIT, this new vehicle, distinct from the QT's platform, is targeting a different structure. It's a non-traded REIT format initially, with an eventual exchange listing, and the D.C. area focus implies they're buying into or developing assets in the Northern Virginia corridor. The $1.74 billion raise is a fundraising target, not a single asset purchase. This is a programmatic vehicle, and for a vehicle of that size and that structure to generate the returns required to attract institutional LP capital at scale, they need to deploy into deals of sufficient size, likely $150 million and above per asset, with stabilized or near-stabilized cash flow profiles that can be underwritten to distribution yield from day one or within 18 months. That requirement is the structural constraint that creates the opportunity I'm about to describe. The mechanism. Why is this compression happening now, not 2 years from now? 3 converging forces. First, the debt maturity wall. A significant portion of the 2020 and 2021 vintage data center construction financing, which was structured on 3 to 5 year terms, often SOFR-based floating rate, is now rolling or has recently rolled. Developers who built in primary markets on the assumption of a 2022 or 2023 exit into a liquid market got caught by the rate cycle. Some of them need liquidity. Blackstone is providing it, at prices that reflect current yield requirements, not 2021 euphoria. That's a recapitalization trade disguised as an IPO. Second, hyperscaler demand has bifurcated. The Microsofts, Googles, and Amazons of the world are signing 200 MW plus pre-leases in primary markets and increasingly executing build-to-suit agreements in secondary markets. Columbus, San Antonio, Phoenix, Kansas City, where power is cheaper, land basis is lower, and regulatory approval timelines are more predictable. Microsoft's announced campuses in Mount Pleasant, Wisconsin and Racine County are examples. Oz's expansion into Indiana, Google's build-out in Council Bluffs, Iowa has been well documented. The hyperscalers are not constrained to Northern Virginia anymore. They have to move, because Northern Virginia is running out of licensed power. Dominion Energy has had well-publicized interconnection queues stretching 5+ years for new large load customers. Third, and this is the mechanism that directly creates the private market opportunity, a publicly traded or non-traded REIT structure has real constraints on what it can efficiently underwrite. Development risk, entitlement risk, power procurement uncertainty, and assets below a certain size threshold all create friction in the REIT model. The cost of capital in a REIT structure is ultimately set by the public market. If Blackstone needs to price this vehicle to yield 5 to 6% to institutional investors, they can't pay 90 cents on the dollar for a powered shell in a secondary market with an 18-month lease-up. But a private operator can, because private operators price to higher, not to current yield, where mid-market capital fits. The specific subsegment I'm focused on is powered shell and build-to-suit development in secondary and tertiary data center markets, at deal sizes between $15 million and $75 million of total project cost. Here's what that looks like in practice. A powered shell is a data center building with a mechanical, electrical, and plumbing infrastructure in place, raised floor, generators, switchgear, cooling infrastructure, fiber entry, but without the IT load. You're essentially delivering a turnkey white space environment to a tenant who brings their own equipment. The development cost in a secondary market, depending on power density and spec, runs roughly $8 to $14 million per MW for a ground-up build, versus $12 to $20 million per MW in primary markets. The land basis differential alone is significant. The deal structure that's working right now in this segment is a development JV with a pre-negotiated build-to-suit lease, or at minimum a letter of intent from a credit tenant, before you break ground. The tenant is often a regional carrier, a cloud-adjacent enterprise, a managed service provider, or increasingly a federal agency. DoD and civilian federal data center consolidation is real demand, and federal tenants will sign 10 to 20-year leases on build-to-suit facilities. If the specs are right, that's an offtake agreement with the U.S. government embedded in a real estate cap structure. The markets I'm paying attention to: Richmond, Virginia, outside the Dominion constraint zone with good fiber density; Reno Sparks, Nevada, low-cost power, Nevada's tax structure, reasonable labor market; Salt Lake City, extremely low power costs, seismically acceptable, growing cloud presence; and Columbus, Ohio, which has moved from tertiary to secondary faster than most people expected based on hyperscaler activity in the last 18 months. The deal structure I'm underwriting to: a development to stabilization IRR of 18 to 24% on a 3 to 5 year hold, with a stabilized exit to REIT buyer or institutional aggregator at a 5.5 to 6.5% cap. That exit buyer could be, in 2 or 3 years, exactly the kind of vehicle Blackstone is currently building. Counterpositions and risks. The bears are right about several things, and I won't pretend otherwise. Power procurement is the single biggest execution risk in this asset class, full stop. Securing a dedicated interconnection with a utility, the transmission study, the interconnection agreement, the substation construction, can take 24 to 48 months in many markets, even where political will exists. You can tie up land, raise capital, sign a term sheet with a tenant, and then stall for 2 years waiting on a utility. That's a real risk, not a theoretical one, and it's killed projects. The AI demand narrative is real, but the specific demand signal is not evenly distributed. The inference workloads driving current data center demand are GPU dense and high power density. A lot of existing legacy data center stock, 1 to 2 kilowatts per rack, older UPS infrastructure, is not suitable for these workloads. If you're buying or developing a low-density facility on the assumption that AI demand will fill it, that's a mismatch. The underwrite has to be honest about what the tenant actually needs. Concentration risk is also real. If you build a single-tenant build-to-suit and that tenant is a venture-backed cloud startup, your investment thesis is correlated to their Series D. Know what you're underwriting. And finally, the interest rate environment. These projects are capital-intensive. Construction financing at current rates compresses development spreads. If rates stay elevated through 2026, some of the IRR math I just described gets tighter. I'm stress testing at 7.5% construction lending and 6.5% permanent financing, and requiring the deal to still clear a 15% levered IRR at those inputs before I get interested. The position I'm taking right now, my focus is on 2 specific deal types. First, I'm evaluating a powered shell development opportunity in the Richmond, Virginia submarket. specifically Chesterfield County, which sits outside the Dominion Northern Virginia interconnection queue problem. The project is approximately 8 MW of critical load in Phase 1, expandable to 20 MW on the same campus. Power procurement is the gating item, and we're currently in the interconnection study phase, with Dominion at a different service territory. Total project cost on Phase 1 is approximately $85 million. The land basis is already controlled. I'm looking at this as a JV structure with a regional developer who has the entitlement relationships and an institutional capital partner on the debt side. Second, I've been in conversations about a ground-up build-to-suit in the Columbus MSA, specifically for a managed service provider with federal contract exposure. That tenant profile, private company, federal revenue concentration, 10-year lease term, is the kind of underwrite I can get comfortable with at the mid-market scale. Total project cost in the $40 million range. The structure would be a preferred equity position at the project level with a promoted interest on the exit. Neither of those deals is in a primary market. Neither of them is at the scale Blackstone is chasing. That's exactly the point. Close. The Blackstone IPO filing is a data point, not a directive. What it confirms is that the institutional compression trade is underway in primary markets and that the public-private spread is collapsing. The alpha that remains is upstream, in development, in secondary markets, in deal structures that REIT vehicles can't efficiently execute. Powered shell, build-to-suit, $15 to $75 million of total project cost, 18 to 24-month development timeline, credit tenant or federal offtake, secondary market power advantage. That's the window. It doesn't stay open indefinitely. The same Blackstone vehicle that's filing today will be the exit buyer in 3 years for exactly the assets I'm describing, but only if you build them now. If you're a developer, operator, or principal working in this space and want to talk structure, I'm accessible. DM me at @DeBrody Official.